Hey everybody, it's Brandon from USAReverseMortgages.net, brought to you by iReverse Home Loans. Today I wanted to do a really quick video about some new changes coming on the financial assessment aspect of the reverse mortgage. As you may or may not remember, the financial assessment is the underwriting guidelines that were brought out by HUD a little while back that basically make it a little more difficult to qualify for a reverse mortgage. But the intended purpose of them is to make sure that the borrower is strong enough to be able, strong enough financially to be able to pay their obligations like property taxes and homeowners insurance. So, the financial assessment was implemented basically before the financial assessment. If you were above 62, lived in your home, had the right amount of equity, you basically would get a reverse mortgage. With the financial assessment implemented, they are going to look into things, or they do look into things now, like property charge history, your payment of your property taxes, your HOA dues, your homeowners insurance, things like that. They look at your credit report to see what kind of a borrower you are. If you show that you don't have a willingness to pay, is what they call it, they will put in place a set aside to pay your taxes and insurance. So basically, they'll approve most anyone still. It just depends on how much equity you have, if you have enough for them to put that set aside into place. Sometimes the set aside can be for up to 12 years. So they would need to set aside 12 years worth of your taxes and insurance to pay it for you. So the financial assessment is being fine-tuned constantly, and there are some new changes that just came out. One of which was kind of good. If you'd had several properties, they were previously checking into the track record of your payment of taxes and insurance on those properties, seeing if you've missed payments, stuff like that. Now that's only going to be on the owner-occupied. On non-owner-occupied, if you have some investment properties, they're just going to make sure everything is current. They're not going to really delve into the background of it. So that's a positive. One of the negatives is they've taken away the kind of compensating factors that you can use to get you to where you need to be to pass the financial assessment. So previously, they were able to use things like cash on hand and proceeds from the reverse mortgage, stuff like that, to get you to where you need to be on the residual income scale. So that's kind of exactly what it sounds like. They want to see that at the end of the month, after paying all your bills, you have some money left over. For two people, it's about $1,000. For one person, it's about $500. So they want to see that after you pay your utilities, your homeowners insurance, your property taxes, and minimum payment obligations on your credit history, things like that, that you have that amount of money left over at the end of the month. $500 for a single person, $1,000 for two people. It's not as difficult as it sounds because they're not counting groceries, they're not counting a mortgage payment, stuff like that. So there are a lot of people, though, that if they are not meeting the residual income requirement, let's say you needed $500 and you show on paper you only have $300 left over, we were able to use compensating factors to get you there. For instance, assets on hand, like money in the bank, we could basically dissipate those assets. Say, well, she's got this much money or he's got this much money. How long would that last towards insurance and property taxes, towards that set aside to kind of avoid the set aside? We'd say, well, they could use this money if they wanted to pay it, theoretically. Also, they could theoretically pay down debt. So say, well, if this borrower didn't have these two credit card payments, they would meet the residual income mark, and they have a bunch of money in the bank, so let's pretend like they're going to be paying it down with that money in the bank. So now they've curtailed that a little bit to where if you're under 80% of the residual income, you can still use HECM proceeds. So any money you're getting out of the reverse mortgage, you can count that towards your income by dissipating those assets. So if it's $200,000, they can divide it over that 12-year period and see how much of your taxes and insurance that would cover, or use it towards monthly income, stuff like that. So now they've pretty much made it so that if you're under that 80% threshold for the residual, you can only use the HECM proceeds. You need to be over, so you need to be having at least 80% of where you need to be. So if it's $1,000 you need to be there for a couple, you need to be having $800 to be able to use some of those compensating factors. So my main point here is the more that comes out for the financial assessment, the more difficult it becomes to qualify. If you have any questions about the financial assessment or what you need to do to qualify, give me a call, send me an email, message me on the website. I do reverse mortgages. I pride myself on giving, the fairest deal in the industry as far as fees and wiping fees out wherever I can. I'd love to get your business, so let me know if I can be of assistance. Thank you very much, and look for more videos. Have a great day.